Guys, this video is of the utmost importance when you study property, plant and equipment. It's a summary of what you should know, at least should know, and hopefully if you battled with a change in estimate or with anything else, this will make it a little bit more clearer to you. Good. The first thing that we want to know is what principles are involved when we're talking property, plant and equipment. You must be able, number one, to calculate the carry value of an asset at the beginning of the current financial year. And there are a few very important words just in that small sentence. The first one is carry value of an asset. Now, what is the carry value of the asset? That is the cost price of the asset less the accumulated depreciation of the asset. So you have to know what you must capitalize as part of the cost price of an asset. You must understand the VAT consequences. Then you must be able to calculate depreciation and accumulated depreciation. There you have to be able to apply the straight line method, the production unit method, and the diminishing balance method. And then the next one that is very important is that you should know that all these calculations, basically, the beginning of the current financial year, that is the first stop. Now, if your asset was used during the year, you must be able to calculate the depreciation on the asset that was used. So if something has happened to an asset during the course of the financial year, it doesn't matter what. I could have scrapped the asset could have been burned down, I could have sold the asset, I could have traded in the asset. But the first question that you have to ask yourself, did I use the asset in the current financial year? And if the answer is yes, then up to the event that took place, whether it being a selling event or a fire, whatever the event was, up to that event, you have to provide for depreciation in your books first. Once you have done so, and you have disposed or traded or scrapped an asset during the year, you must be able to calculate the carry value of the asset, not as at the beginning of the year, that's the starting point, but as at the date of disposal or scrapping or trade-in. Thereafter, what do we want to do? We want to calculate the profit or loss on the disposal, trade-in or scrapping of the asset. Where do we do that? In the asset disposal account or the asset realization account. How do we do that? Now guys, we have done this in study unit 8. What is the first step? Transfer the cost price of the asset to the asset disposal account. What is the second step? Take the total accumulated depreciation, i.e. as at the beginning of the year, plus the depreciation in the current year. Take that out of the accumulated depreciation account and transfer that to the asset disposal account. What is step number 3? Determine what is the amount that we have received for the asset that we have disposed of. If we did receive it in cash, we will debit bank with the full amount. If we are a VAT vendor, we will credit the asset disposal account with a VAT exclusive amount, and we will take the VAT portion to the VAT output account, and then whatever the balancing figure is that we're going to retain in the asset disposal account, that will then be either the profit or the loss on the disposal of the asset. If a new asset was acquired during the year, number 1, determine the cost price of the asset. And now listen very carefully. Go to your textbook. In your textbook, there is quite a number of paragraphs where he explains to you what type of costs are included in the cost price of an asset and what type of costs are not included. And that is important for your little Ifundi test coming up on Monday. So make 100% sure that you have read that paragraphs in your textbook and make sure that you know what can be included and what cannot be included. Now, once I have the cost price of the asset, I can now determine the depreciation on that asset based on my depreciation method that is applicable on that class of asset. And then determine also, after I've done that, don't forget about your old assets. You had certain assets in the beginning of the year which you still have at the end of the year, and I must also provide on those assets my depreciation expense for the year. Now, disclosure. The first thing that is important is accounting policies. Now, Basis of presentation, that is my first accounting policy note. And what is that all about? I tell the user of the financial statements, how did I account for my assets and liabilities in my financial statements? So the financial statements were prepared on the historical cost basis, except for land and buildings that are revalued and financial assets that are shown at fair value. Now, the only thing that you will have, you won't have, oopsie, this year, the financial asset story. But you may have that something has happened and we have decided to revalue our property. So then, when we're going to start with accounting policies, and I require the accounting policy note, you will start with your basis of presentation, telling me that all the figures except our land and buildings was prepared on the historical cost basis. Land and buildings were actually prepared on the revaluation method. My second accounting policy note is the note specifically based on property, plant and equipment. Now there I have to state clearly that property, plant and equipment are stated at cost less accumulated depreciation, cost being historical cost. Other than freehold land and buildings on which depreciation is not provided, depreciation is recorded by a charge to the income statement computed as the right of the cost of the asset over its expected useful life. The rates are as follows. So you must tell them you're using the cost principle, you transfer to your income statement each and every year depreciation charge, and then per class asset, I must tell them exactly what depreciation method I apply. Plant and equipment, for example, 5 years on the straight line basis. There's a little spelling mistake. And motor vehicles, for instance, 20% per annum on the reducing or diminishing balance method. And let's say machinery and equipment on the production unit method. So for every class asset that you have, you also have to tell the reader what is the depreciation method that you use. The next thing that you must be able to do is the IAS 16 note. Now you know that there should be a different column for every class of asset. And you know that this note is actually divided into 3 sections. The first one, the carrying value of the assets as at the beginning of the year, broken down in cost price and accumulated depreciation. The second section is my movements for the year. And there we will have things, if I have revalued my asset, I have to show it somewhere, otherwise I'm not going to balance. So if there was a revaluation of land and buildings, it will appear on the IAS 16 note under land and buildings. In this case, let's say 500,000 rand. Additions at cost price, that has to be shown per section or type of asset class. Disposals at carry value, depreciation expense for the year. Now, listen more, the disposals as well as the depreciation, that is expenses that actually reduces the value of my asset, so therefore it needs to be shown in brackets. And then I close off with my carrying amount at the end of the year, again broken down between cost and accumulated depreciation. And if there was a revaluation, it's not only cost anymore, it will be cost slash revaluation with the amount there. So that 4.9 million is not only cost, it also includes that 500,000 revaluation. Now listen carefully to the old woman here. The first thing that you have to know is, let's say for instance aircraft. Aircraft, if you think about the body of an aircraft, if you think about the engines of an aircraft, and if you think about the interior of an aircraft, guys, it's very clear, you don't have to be a genius to figure out for yourself that you cannot apply the same depreciation method, the same estimated lifetime of those different components of the aircraft to make sense. So for sure, the engine will have completely, I would like to think you're going to use the production unit method on the engine, where maybe on the body of the aircraft, you maybe can use the straight line method. And for the interior of the aircraft, because you're going to use up more of that interior in the beginning, probably the diminishing balance method is going to be more applicable. But I'm not going to go in the IAS 16 note and break down aircraft here between the body of the aircraft, the engines, and the interior. No, I only have one column here, aircraft. Although in my calculations, I'm going to break it down into the body, into the engines, and into the interior, and work out separately for each three of those components all the movement for the year to get to total depreciation, to get to disposals at carry value, or additions at cost price, whatever the movement is that took place. I'm going to do that separately in a calculation format for all the different components. But when I complete my IAS 16 note, I'm going to add all the line items together. I'm going to add all the additions together. I'm going to add all the disposals that carry value of all the different underlying components together. And I'm only going to show one single figure on my IAS 16 note. Listen carefully. If you're going to break it down in components, you are not going to get one single mark for your effort. You're not going to get any calculation marks because you don't know how to disclose that thing correctly. Good. If I had land and buildings, I also have to tell the reader where it's situated, and if it was pledged as security against any loan, I have to mention the fact. The second note that you must be able to write is your profit before tax note. You will say profit from operations is derived at after taking the following into account: 2014 Rand, 2013 Rand, so comparative figures. You have to show income separately from expenses. So under income, you will show profit on the sale of assets. So you will identify it here and you will show it separately. Under expenses, you have to show losses on the disposal of assets and you have to show it separately. Then your depreciation, that needs to be disclosed per class of asset. So here you have to distinguish total depreciation, but then broken down how much for property, how much for plant, how much for equipment, and how much for vehicles. Let's assume that you have now entered that, and listen, this is in the note, So let's assume you have the breakdown of property, plant and equipment, but we had a change in estimate on the way that we provide depreciation of vehicles. Then you will say depreciation vehicles. You will have the total that you've written off this year and last year on vehicles. And then you will have a subsection where you're going to tell the reader what was the original estimate. So if you did continue the old way, what would your depreciation charge have been? That one there on top is the actual depreciation charge. So obviously the difference between the two will be the impact of the change on the current year's figures, and that will be attributable to the change in estimate. So make sure that you can actually disclose these things properly. And then you have to make a change in estimate note. So you have to tell the reader what changed and what was the impact of the change on the current year's profits as well as future profits. So during the current year, there was a change in estimate with regards to depreciation on aircrafts due to a change in the total estimated number of kilometers, changing from 2.5 million kilometers to 2 million kilometers, as well as a change in the residual value from no residual value to a residual value of 100,000 Rand per aircraft. The effect on the current year profit is a decrease of 222,019, and future profits will increase by 422,019, or whatever the figures are. Now, let's quickly do an example. Now, guys, we're going to read it, then you pause the video, you do the calculation, and then you come back to the video. Assume ABC bought an asset with a cost price of 100,000 Rand on 1 January 21. The asset needs to be written off over the estimated lifetime of 10 years on the straight line basis. On 30 June 25, ABC traded this asset in for a new asset. They made a loss of 5,000 Rand on the transaction. ABC had to pay 69,000 Rand to the dealer towards the cost price of the new asset. Show all journal entries if the new asset is also going to be written off over 10 years. The year end is 31 December, and let's assume a VAT rate of 15% and that ABC is also a VAT vendor. So quickly, let's do the calculation then. First step is to determine the carry value of the asset as at the beginning of the year. The cost price of the asset on 1 January was 100,000. We've written off it over 10 years and 4 years has gone past up to the beginning of the current financial year. So the carry value of the asset at the beginning of the year is 60,000. Have we used the asset in the current year? Yes, we've sold it on 30 June 25, so we have used it for 6 months. So therefore our depreciation charge, step number 1, is 5,000 Rand. What was our carry value of the asset at the date of sale? Well, 55,000 Rand. We made a loss of 5,000 Rand. Here's our loss. So that means if we made a loss, we received 5,000 Rand less than the carry value of the asset. So we have received 50,000 Rand. However, this is a VAT exclusive amount. What would we have received? A VAT inclusive amount. So what did we pay for the new asset? We took out of our pocket 69,000 Rand, plus we received 50,000 Rand plus VAT for the old asset. So the new asset, the cost price of the new asset will be the amount that we have paid, 69,000, plus the VAT inclusive amount, 50,000 times 1.15, 126,500. We can claim the VAT, 15% VAT included in that amount, which is 16,500. So the actual cost price of the asset is 110,000. We're going to depreciate that once more over 10 years. It was for 6 months, so therefore our depreciation charge 5,500. So, what is our steps that we have to follow? Pause depreciation if the asset was used during the current financial period. That was our first step. Take the cost price of the asset and transfer it to the realization account or the asset disposal account. Transfer the total accumulated depreciation inclusive of the current year's depreciation to the asset disposal account. Account for the proceeds on the sale, the 50,000. Balance your asset disposal account to determine the profit or loss on the disposal of the asset, the 5,000 Rand. And then we record the new asset and calculate the depreciation on the new asset. The journal entry. Here is our depreciation for the current year. Then we take out the cost price of the asset to the asset disposal account. We take out the total cumulative depreciation, the 40,000 up to the beginning of the year, plus the 5,000 of the current year, i.e. 45,000, to the asset disposal account. So there's the cost price, there's the total accumulated depreciation. The next step is to record the proceeds. Now this is a trading transaction, so we're going to debit the dealer with a full amount that he is supposed to pay us, which is the 50,000 plus the VAT, 57,500. The VAT exclusive amount goes to the asset realization account. The VAT portion will go to the VAT output account. And then we're going to balance off our asset disposal account, and we will see that there the balancing figure on the credit side, on the asset disposal account, so the debit will be in the loss account. Because it's a debit in the loss account, it is a loss and not a profit. Then we're going to account for the new asset. Now, the dealer, he owes us 57,500. Here I just split the 57,500 so that you can see exactly how it was posted. 50,000 went to the asset disposal account, 7,500 went to the VAT output account. The new asset we have determined cost 126,500, and here again I just split it. I took 110,000 to the asset account, the cost price of the asset. 16,500 would go to the VAT input account, and then I owe the dealer the full invoice amount of 126,500. So I owe him 126,500. He owes me 57,500. If I'm going to subtract the two from each other, I have to pay him in the additional 69,000, which I in actual fact have done. I debit his account with 69,000 and I credit bank with 69,000. The asset is out of my books, the old asset. The new asset is in my books at 110,000. I have settled the outstanding amount with the dealer, so I can just carry on with my new asset. Great stuff. Let's then continue with the change in estimates, and let's do the reallocation method first. Now guys, I have actually written down a roadmap for yourself how you must go about to answer a question with a change in estimate. What is the steps that you need to follow? The first step is determine the carry value of the asset in the beginning of the financial year where the change in estimate took place. So that would be the current financial period that you are working with. So determine the carry value of the asset where there was a change in estimate in as at the beginning of the current financial year. Step 2. Now, whenever I do a change in estimate, I'm going to have 3 columns. Old, which represents the old way of providing for depreciation. New, which is representing the new way of providing for depreciation. And the third column is difference. Now, you will see that we are going to do certain things with the differences. So, step number 2 says, I'm going to continue with the old way, the way that I've done in the past. Once I have the carry value at the beginning of the year, I'm going to continue with my calculations to work out what would my depreciation charge have been based on the old way of providing for depreciation for the year. Why? Because somewhere along the line, I have to disclose what was the impact of the change in estimate on the current year's profits. And if I don't know what depreciation charge I would have passed against my profit for the year, how can I work out the impact of the change? So therefore, I'm carrying on right to the bottom with the old way of calculating depreciation as well. Now I'm going to move over to my new way. And where do I start with my new way of calculating for depreciation based on the new estimate? Now we're talking about reallocation method. So our starting point for the reallocation method is the carry value of the asset in the beginning of the current financial year. So that's my starting point in the new column. My carry value of the asset at the beginning of the year. Then step 3 says, determine the remaining lifetime of the asset, whether it being in years or whether it's capacity, whatever it is, as at the beginning of the financial year. Now here we catch you out every now and then because I give you the remaining lifetime of the asset as at the end of the financial year when I decided to do the change in estimate. And you merely go along and you forget that at the beginning of the current financial year, I had to add a little 1 to that number of years left from the end of the year. Don't let me catch you there, be wide awake. Great. Now determine the new depreciable value of the asset. Now what is that now? That would be my carry value of the asset at the beginning of the year, less any new estimated residual values at the beginning of the year. So that is now the amount that we want to depreciate over the remaining lifetime of the asset. So when we want to work out then depreciation, it will be the depreciable value, i.e. the carry value less the new residual value, divided by the remaining lifetime, number 3, of that asset or the capacity of the asset, and that would be our actual depreciation charge for the current financial year. Now once I have my actual depreciation charge for the current financial year, I can determine it, I can compare that with what my depreciation charge would have been if I continued with the old estimate, this one in 2. And the difference between 5 and 2 is the impact on the current year's profit. Step 7 is I have to tell the reader of the financial statement what is going to be the impact on future profits. So therefore I have to determine how much depreciation would I have written off as from the end of the current financial year in the future on the old way of providing for depreciation, in comparison of how much I'm actually going to write off by applying the new estimates in the future. So for that, I need the carry value of the asset at the end of the year based on the old method, and I need the carry value of the asset based on the new method. And then I have to determine how much depreciation are we going to write off. Now remember, we're only going to write off depreciation always up to the estimated residual value. So if I have the carry value at the end of the year of the asset based on the old and the new method, I'm going to subtract from that amount our estimated residual value. And the difference between the two is going to be the future depreciation that we're going to write off on that asset based on the old way and based on the new way. Now, what happens if either one of the old method or the new method is now based on the diminishing balance method? Now we say for diminishing balance method, we ignore the estimated residual value when we do the depreciation calculation. Why? Because that estimated residual value has already been taken into account when we actually determine the percentage that we want to write off on the diminishing balance method on an annual basis. Guys, but if you do the calculations, you will see that by applying that percentage, you are only going to write off the asset up to its estimated residual value. So if I want to work out the impact on future profits, I have to take the estimated residual value also into account when I work on the reducing balance method. And this is the only place where you're going to take the residual value into account. Why? Because I'm not going to write it off as depreciation. Once I have written off all my depreciation that I actually aim to write off on that asset, I will end up with the estimated residual value of that asset in my books. So therefore, I have to take down the residual value in all instances. Now, the old way, so the old depreciable amount, so the future depreciation that I've calculated in A, in comparison with the new way, also calculated similarly, the difference between those two will be the impact on future profits. So what did I calculate in the first column? The first column I calculated how much depreciation am I going to write off this asset from the end of the current financial year forward on the old way, and then also in the new way. So how much future depreciation am I going to write off the asset in actual fact in future years as from the end of the financial year, and then the difference between what I'm actually going to write off and what I would have written off based on the old way of depreciation, that will be the impact on future profits. Let's do an example. ABC had machinery on 31 March with a cost price of 730,000 and accumulated depreciation of 408,000. The machine is written off on the straight line basis over a useful life of 5 years. No residual value was estimated at the time of purchase. The total capacity of the machine is 1,600 units. On 31 March 25, 560 units had been produced by the machine, and in 26, a further 220 units were manufactured. Management decided on 31 March 26 to change the production unit method and estimated a residual value of 50,000 Rand for the machine. So again, pause this video and do the calculations by applying the steps that I've set out for you to apply. Number 1 was determine the carry value of the asset as at the beginning of the current financial year. Was the cost price less accumulated depreciation, and that gave us a carry value at the beginning of the year of 322,000. I'm going to start my new way with the 322,000. I don't even have to write that down, guys. I can just start here with 322,000. Step 2 was to calculate depreciation based on the old way for the current financial period as well. So I've written it off over 5 years. That would have given me 146,000 Rand depreciation. Now, step 3 says, determine my remaining lifetime or the remaining capacity of this asset that I'm re-estimating depreciation now. Remaining, guys, and I want to take you back to the question yourself. We're going to get there now. The total capacity of the machine was 1,600 units. But up to the beginning of the current year, we have already used 560 units. So I cannot work with 1,600 units. I have already gobbled up some of that capacity, i.e. 560 units. So what is the capacity of this machine at the beginning of the current financial year? only the difference between the two, which is 1040 units. In the current year, we have produced a further 220,000 units. So the remaining capacity at the beginning of the year, 1040, the depreciable value is the following step, and that would be my carry value, 322,000, less my estimated residual value of 50,000, so the depreciable value is now 272,000 rand. Good. Depreciation. My depreciable value divided by my remaining capacity of 1040, which gives us 261.54 per unit, multiplied by our number of units for the year, 220, and that gives us total depreciation for the year, 57,538. Great. Now we can determine our carry value as at the end of the year. Impact on current year's profits. How much depreciation is going to appear in our income statement? 57,538. What is our depreciation expense for the year? 57,538. What would it have been if we did carry on with the old way? 146,000. So what is the impact on our profits for the current year? We're going to write off less depreciation under the new way than what we would have under the old way. So therefore, it's going to be a positive impact, the difference between the two, on our current year's profits of 88,462. Now we want to calculate the impact on future profits. And where do we start? We start with the carry value of the asset based on the old way, as at the end of the financial year, 264,462. We're going to determine how much depreciation we would have written off in the old way. Well, there was no estimated residual value, so we would have written off the full 176,000 rand based on the old way. How much depreciation are we going to write off in the new way? Well, now we have an estimated residual value of 50,000. So we're only going to write off 214,462 rand in the future, because up to residual value, that is the depreciation that we're going to write off. So we're going to write off under the new method more depreciation than under the old method. So the impact on future year profits is going to be a negative impact of 38,462. The cumulative catch-up method. Now, what is the steps that we have to follow here? The first step is, again, determine the carry value of the asset as at the beginning of the current financial year when the change in estimate took place. In all of them, it doesn't matter what you do, that is your starting point. What was the carry value of the asset at the beginning of the current financial year? And then I'm going, like in the previous method, I'm going to continue with the old way in this year. Determine what the depreciation would have been based on the old estimate for the current financial year. Cumulative catch-up says, now I'm going back right to the beginning. I'm going right back to the acquisition date of the asset. And then I'm going to redo all my calculations based on the new estimates since acquisition date. So I want to determine the carry value of the asset at the beginning of the year, but now based on the new estimates. So I started the cost price. I'm going to recalculate my accumulated depreciation up to the beginning of the year, and I will derive at the carry value what the carry value of the asset would have been if I did apply the new estimates since acquisition date. Now, in my books, I sit with the actual accumulated depreciation. I've now calculated in 3 what the accumulated depreciation must have been if I did apply from the start of point the new estimates. So the difference between my accumulated depreciation balance actually in my books and the accumulated depreciation balance calculated based on the new estimate, I have to make a correction for that. So I want to change my accumulated depreciation as at the beginning of the current financial year to the amount that it should have been based on the new estimate. How? I'm either going to make my accumulated depreciation more or less depending whether I have too much or too little in my books, And the counter leg of that entry will go to my depreciation expense for the year. Now guys, that is our catch-up depreciation. That is our catch-up depreciation. Then in 5, I'm going to carry on the new way with based on my new estimates, and I'm going to calculate my actual depreciation for the year based on the new estimate. Now my total depreciation charge is then going to be my catch-up depreciation plus my actual depreciation calculated in 5. So this is 6. Then I'm going to calculate the carry value of the asset at the end of the financial year based again on the new and on the old method. I'm going to determine how much future depreciation I'm going to write off the asset based on the new method and the old method by taking into account residual values. And then the difference between the old estimate and the new estimate will then be the impact on future profits. So there is exactly the same thing. Let's do the same example. ABC had machinery on 31 March with a cost price of 730,000 and accumulated depreciation of 408,000. The machine is written off on a straight line basis over the useful life of 5 years. No residual value was estimated at the time of purchase. The total capacity of the machine is 1,600 units. On 31 March, 560 units had been produced, and in 26 a further 220. And then they decided to change to the production unit method with an estimated residual value of 50,000. Step 1. Determine the carry value of the asset at the beginning of the current financial year. Step 2. Carry on with that calculation and calculate what my depreciation charge would have been if I continued with my old way of depreciating the asset. Step 3 is start all over again, and then I'm going to start at the acquisition date and rework what my accumulated depreciation up to the beginning of the current financial year would have been if I did apply the new method. So 730,000 less our new estimated residual value of 50,000 divided now by our total capacity, because we start right from the beginning, multiplied by the number of units produced up to the beginning of the current financial year, the 560. So that is 425 Rand per unit multiplied by the number of units gives us a total accumulated depreciation as at the beginning of the year of 238,000. What do I have in my books? I have 408,000 in my books. So I want 170,000 Rand less in my books. So let's do that rectification. I have to debit my accumulated depreciation with 170,000, and I'm going to credit my depreciation expense account, credit. So it will be income in inverted commas of 170,000. That is my catch-up. The difference there, that is my catch-up. Then I'm going to continue with my calculations, and I'm going to calculate my actual depreciation charge for the year, which will be 425 Rand per unit multiplied by 220 units produced, which is 93,500. And that now is my second component of my depreciation charge for the year. So my total depreciation is going to be a difference between those two. So it's going to be a net credit in my income statement of, what is the difference? 170,000 less 93,500, 76,500. Step 6, determine, here it is, 76,500, our total depreciation for the year. Step 7, 8, 9 is to determine the impact on future profits. So where do we start? We start with our carry value at the end of the financial year. We're going to have a look how much depreciation we're still going to write off in the future. There's zero residual value, so we would have written off the full 176,000. Here's a 50,000 residual value, so we're only going to write off 348,500. So that means then that the impact on future profits is going to be a decrease in profits of 172,500. I'm going to write off more depreciation on the new way than I would have in the old way. Guys, at the end of the day, this is a zero-sum game because what is the maximum depreciation that we can write off? Only 730,000. We can never write off more than 730,000 because you cannot write the asset into a negative value. So it is all about when are we going to write off a portion of the 730,000. So over time, the full 730,000 is going to be written off. Now, can you see that manipulation can kick in if I chop and change this way of calculating depreciation as I want, depending whether I want profits or whether I do not want profits. And that is the reason why we have to give this full disclosure of the impact of the current year's profits as well as the impact on future year's profits. So if this year was gross, here you can see it is a huge benefit for us, 76,500 Rand benefit, increase in profits this year. But boy, oh boy, in the future, it's going to hit us very hard because we're going to have an additional expense of 172,500.